Transition is a regional partnership of economic developers, of folks who provide technical assistance to small businesses, and interested community members who want to ensure that the businesses that we have throughout our region are able to continue to operate and have a succession plan in place. Most business owners, not most, but quite a fair deal of business owners that we talk to, really need to sort of build a succession plan in order to transition their business to a new generation, but have some work to do to make sure that they're doing that in the best way possible, and to sort of learn about it. So we provide free and low-cost resources throughout the Adirondack North Country to help people connect with some of those answers to those questions as folks are moving forward with their succession planning journey. I hope that everybody did have a good and healthy and happy 4th of July weekend, that you were able to enjoy the sunshine and this beautiful place that we live in. But also, I just want to start with sort of recognizing that this is an unusual time for folks, and we've been building the CBIT, Center for Business and Transition Partnership, over the course of a year and a half. But right now, some of the assumptions that we've made or the things that we've learned may have changed a little bit given the current crisis with COVID-19. And we wanted to make sure that we're being as sort of transparent as possible about maybe some of those changes in your own planning that you should make, and to be able to connect you with resources that are still available, or if there's new stuff that pops up, that we're making sure that we do all of that in real time. But that being said, there's a lot of the things that we just don't know the answers to right now, and we can sort of work through them together. A lot of folks that have been calling us have questions about whether or not banks are going to be lending right now, or whether or not real estate values are going to change. And those are kind of the questions that we can't necessarily give you the answers to, but we are providing a platform to help support those kind of questions and the kind of thinking that we need to do as we go through this trying time together. So that's why we're so thankful today to have special presenters with us at BNC, and they're going to sort of answer some of the questions that folks had submitted in advance of the program. There are other questions that folks had submitted that we will get some other presenters who might be more versed in those particular fields to be able to answer hopefully within the next month or two. But we're just really grateful for our guest presenters today to be able to come and talk about answering a lot of these questions, or at least taking a stab at it, that deal with valuation and uncertainty and succession planning during this trying time. So I will say that all of that, we're really grateful to have them here. They are a private practice, so we don't support one practice over another, and we're not outright recommending them. We can't do that as a nonprofit organization, but we are so glad that they're here to sort of share their expertise with us and talk to some of these issues. I also want to note that we have quite a few of our CBIT partners on the line this morning, folks working throughout the region on these issues every day. So I see Angela Smith from the, let me make sure I get this right, SUNY Canton at Clinton Community College SBDC office. I see her on the line. I think we have Russ Kenyon from the Franklin County IDA, Brooke Rouse from the St. Lawrence Chamber of Commerce. We have, I'm just going down the list here, Kylie Peck from the Greater Watertown Chamber of Commerce. We have Stephanie from the AEDC. I think we also have a few other folks from the SBDC, Victoria Dooley from the AEDC, Brittany Davis hailing over from the Lewis County IDA and naturally Lewis, Dan Kelleher from the APA, and who else from the partnership am I missing? You can unmute yourself and just say your name and where you're from if you're on the line. Did I actually get everyone? No way. Okay. Well, if it comes up later, let me know. And just a sort of bit of housekeeping before we get started as well. There is a chat box. If you hover over the bottom of your screen, there's a little chat box. And if you want to send me or anyone questions directly, feel free to put them in there. If you have questions as we go, we can do that as well. Also, Steve Garnow is joining us from the AEDC too. All right, well, thank you so much, everybody. I'm so excited to get us started. I'm gonna go ahead and share my screen with you. And this should There we go. And I will let our presenters take a minute to sort of introduce themselves, and then we'll just get right into it.
Good morning. Hopefully everybody can hear us. We are happy to be here this morning. This is, I think, maybe our only second webinar since this whole COVID thing hit. Specifics to business valuation and taxation and what have you. So this is kind of a new road for us as well. So as an introduction, I'll introduce myself and then I'll have Terrell introduce myself. My name is Rick Tidd. I'm a partner with Bowers & Company, CPAs. I'm located in Syracuse, New York. And as you may know, we have an office in Watertown, New York. I have clients North Country. I have clients all over the country. My practice specializes in corporate taxation and business valuation. I've been in practice now for about 15 years or so. And like I said, with a emphasis in tax and business valuation. So I'll turn it over to Terrell. I'll let her introduce herself, and then we will start in.
Hi, everyone. I'm Terrell Sullivan. I also work at Bowers & Company CPAs. I'm a tax manager here. Been here about 7 years, and my focus is tax, corporations, S corps, partnerships, and then I also work in valuations. So I guess we can get started. We have some pre-questions that we were given ahead of time, so we're going to hit those questions first and talk about them a little bit, and then I guess at the end we'll have time for if there are additional questions on top of that.
Yeah, okay. So just, I guess as an introduction, I want to say outright that I think the goal here is we're going to try to keep things at a broad perspective. I think we have to, based on what's going on. Everybody's business is affected differently. Every industry has been affected differently. We certainly see that in our client base. Some clients have done very well, other clients not so much. So we're going to try to keep things broad. I think right now it's hard to predict exactly what is going to happen, especially on the business valuation side, until things kind of get opened up. And I think we have seen that really depends on what state you're in, what industry you're in, and really it's coming down to even are you in a Republican state or a Democrat state. You know what I mean? We have issues to deal with such as that. So I guess I'll address the first question as to how do I preserve my business value during an economic downturn? I wish I could say that's an easy answer, but it's not. We don't have a lot of experience with pandemics here and business valuation, but what I can tell you from business valuation perspective, I don't think it's changed. I think the two major items to keep a handle on are risk and cash flow, which I don't think that comes as a surprise, but on the risk side, I think the question we've been asking our clients is, really, can I operate differently under COVID and still have access to my customers? So, for example, we have restaurants that went to takeout, so they still have access to customers. They certainly have more risk with COVID because they can't have, in-dining seating and what have you. But they were still operating, and they still had access to their customers somewhat. Where you take somebody like a hair salon, that risk immediately became super high, super questionable, because now they for months could not see anybody. So I think the questions we're asking at this point and the risk side is, when I do open back up, how can I mitigate the fear of COVID? How can I get my customers back in the door? How can I preserve a safe environment? And will my employees feel safe? So I think risk is huge here. And those are the things that we would be focused on, along with cash flows, to try to assess. Risk has most likely gone up for everybody, I would say. I'm not sure that it hasn't. I mean, I'm sure there are some suppliers and things like that their risk has maybe gone down a little bit, but for the most part, I would say no. I think it's a matter of assessing the risk, and once this thing eventually we get back to what normal is how do I look when I come out of the norm, and how has my risk changed? And that's going to be very difficult, I think, to predict, especially when a lot of the country really is still not open, or at least everybody's not open. I know, like, gyms in New York State at this point can't open. And so until we kind of get a little further down the road, I think it's going to be difficult to assess that risk. As to the cash flow side, I think that remains the other side of a two-legged chair here is, how do I maintain my cash flows? Because that really, in the end, is the driver of business. And how do I maintain those cash flows through the pandemic, and then once I come out of the pandemic, can I get back to what normal is? And I think you're going to see, or we are seeing, some business models that are going to change. That, again, along with a risk assessment for our purpose, is going to be how do we have a client prove to us that our cash flows are going to come back, or maybe they're going to come back in a different manner. But those are the two things that I would, say, focus on as to a preservation of value is risk mitigation during the pandemic, after the pandemic, and how do I keep my cash flows, at the best level that I can, and with a goal to getting back to normal, and what do I have to do to get back to normal? And those are going to be difficult questions. They are difficult questions, and I think, but those are the two main things that are going to drive value. Whether it's pandemic or non-pandemic, I would say those are the two drivers of value. The other thing I would say is I think our approach to valuation, which I think maybe stems off this, is going to stay the same somewhat. I think the approach stays the same. I think that the big thing for us, and we've already seen this, is how do I do valuations based on the date that I want them done? So, for example, obviously we had done a lot of valuation work at 12/31/19. So we immediately had questions as to how do we make an approach to valuation now when I'm doing a valuation, say, in March of 2020, but the date is 12/31/19. So we have to deal with an issue when it relates to value as to how do we deal with subsequent events, things that have happened after the valuation date. I think that is going to be critically important as to how we make an approach that in a lot of cases really almost didn't have an effect on us before. So that being said, I think I can give you some examples of what we've done at 12/31/19, and our procedures and the guidance that we have is generally as to subsequent events. We can only deal with and value with things that were known or knowable at the date. So, for example, we do a lot of valuations at the end of the year. We did a lot for 12/31/19. This issue of COVID and the shutdown, whatever, was not known as of 12/31/19. So we are, in most cases, not allowed to look at events that have happened after that date unless a reasonable person could have foreseen that was going to happen. And I don't think at that point anybody could. We have started adding some language to reports stating just that. I think the first case probably of COVID was reported somewhere in mid-January. So even at that date, just because the case was reported, I don't think that really has in effect, I can tell you that I wasn't aware of certainly what was coming because of a single case. You know, you started getting valuation dates that are mid-February, late February, where you could predict some of this or you thought was going to come. Those are going to be difficult because even at those dates, I don't think any of us had a clue really what was coming. And I think once mid-March, once the lockdown kind of starts, I think we can start to really get in some definitely meaty issues as to value, how it's going to go forward. We've already had clients certainly ask, you know, should I gift my shares back at 19 or should I wait and gift them in May of 2020 because I'm going to get a lower value? Well, you definitely may get a lower value in May of 2020. But I think based on the risk that I talked about, the cash flows that I deal with, the cash flows for most people are certainly going to be down in May 2020 for most, not all. It's a matter of how do we normalize COVID? You know, I don't think we can, you can't necessarily look at a business and say, at May 2020 it was worth this because how long is it going to last? Maybe they only affected for 3 months, they opened back up and did fine. So again, with evaluation always looking forward, I think we have to consider how long did COVID affect the business that we're looking at. Some are going to deal with it for a long time. Some may never recover. Some may have to change the way they do things. We have other businesses here, other clients here that have done well, and for the most part have not been super affected by COVID directly. Their cash flows that I see, even in the 2020, they look good. So has COVID affected them? Probably. It certainly has in certain internal operations. But when I look at the bottom line, those numbers are still good. So that, I think, is going to be something that's different for us when we look at businesses to value, is how to deal with the date on which we're valuing the business, what was known at the date. I think as far as the valuation methods, we're still going to focus on cash flows, assets, and a market approach. So cash flow, I think, is going to end up being king, and we'll probably cover that a little bit more. As far as assets, you know, we if you have real estate and stuff, we certainly use appraisals for real estate valuations. Definitely could have an effect. I think the caution with a market approach of the third leg of that, I think we're going to have to be very cautious with looking at other companies on the market side of things, because everybody's going to be affected differently, and to look at what we used to do is say we'd find similar companies to yours that we were valuing, and we might maybe take an average of those companies, what they sold for, how they sold, what cash they got. That's going to be very different now, because you have to dig in and see how those companies that we're looking at were affected by COVID. And maybe it's different than the way you're affected by COVID. So sometimes I think the market approach, or finding similar companies in the market, is going to be more difficult than it was even before, because COVID is affecting everybody somewhat differently.
Yeah, and sometimes people will use like a rule of thumb. They'll go online and just find like rules of thumb, oh, I can sell it for 3 times sales, but depending, I mean, it's going to be a lot trickier to try and to rely on that, because 2 of the same types of businesses could have reacted to COVID in very different ways. So to just use a generalized rule of thumb, which are a lot of times have been generated even prior to COVID, is probably not going to be your best option when you're looking for really digging into what the value of your business is now.
Yeah, I would agree. That's a good point. We get a lot of calls actually with people saying, look, I don't want a business valuation really, but I just want to get a general idea, or I have an idea in my head. And like Terrell said, we will maybe pull some similar companies or similar industries and say, okay, here's as a general rule, you're going to sell 4 times EBITDA. And it's helpful because it gives people a general idea, and I think that's going to become even a little more dangerous, as you said, because you really don't know the effects now, what's behind those numbers, because every industry has been impacted by it. So I guess if you guys have questions, you can send those in. We can answer questions whenever people want. If not, I think we'll probably move on to the second question.
So the second question we had was, how might the pandemic change the value of my business? I mean, I think the pretty obvious answer, at least in the short term, is most people are going to feel a negative effect from it. A lot of businesses had to close. How long did you have to close? There's certainly exceptions. I mean, Home Depot, I think, is doing just fine.
Yeah. Every time I go down, there's a long line.
Yeah. Like you said, a lot of it's going to be, looking at your cash flows. But when you think about how is this possibly going to affect the value of my business, there's a lot of economic considerations that take into effect, and it's different business to business, industry to industry. So, for example, he mentioned a hair salon. Do you have a business where the services or the products are time sensitive? Because if you don't provide hair services in March and April and May, you're not going to make those up. Somebody's not going to come in and say, hey, I missed the last 3 months of haircuts, I'm going to need 3 haircuts today. So that's strictly lost revenue. Maybe this has caused you to diversify into a different type of business. There are a lot of companies that started making hand sanitizer because there was such a big demand for it. So they kind of mitigated the impact on their value because they found a different way to bring cash flows in. You may have a lot of extra costs now with whether you're doing protective screens or masks or offering them to your customers, your employees, sanitizing. And you kind of have to decide how long is this going to affect your particular business, the type of business that you're in. A lot of companies have tried to make sure that they can sell online if they have products or even services. Restaurants are doing more online ordering. Are you already set up to do that? Do you need to spend money to get to that point, to be competitive, to remain competitive, especially if this is a longer-term thing? What are you doing, basically, to make sure that your cash flows keep coming in? And another consideration is what are the composition of your customers? Do you deal with like very affluent people in the services or products that you provide? Maybe they didn't have as much of an impact, whereas if it's like fast food or stuff that's maybe a little more, your demographics have been a little more affected by it, then maybe that's going to hurt your cash flows more. What kind of businesses do you deal with? Are your business customers the type of business that's going to be affected negatively by this? Maybe they can continue on and you're not too worried about it. So there's a lot of considerations as to how it's going to change the value of your business, and a lot of it's going to come down to how quick do you react, identifying the risk like he talked about, and how quickly do you mitigate it? How do you go about doing that? The next one, there's a question about if you've already done a business valuation, should you update it? That's going to kind of depend on what you're relying on it for. If it's for a estate or gift, a lot of times, depending on the timing of when you had the last one done, say you had one done at 12/31/19 and you want to do your gift as of early 2020, you should be fine. I wouldn't say you need to do a new valuation, but if you had one done 3 years ago and now you're wondering what it's worth, or you have, shareholder operating agreements that require them, it may be time that you want to update it, just because you have to kind of see how this has affected your business, what you expect going forward. You may not just be able to rely, especially if your valuation was done based on your historical cash flows, and you're expecting them to be far different going into the future, then yeah, you would want to get your valuation updated. So it kind of depends on what you're using it for, how old is it, maybe what your operating agreements specify.
I'll add to that. I guess from the IRS side, we do a lot of valuations for estates and gifts, and the theory is exactly like Terrell said, if we value something at 12/31/19 and say COVID didn't happen and things, some businesses are very steady. They generally do the same thing every year. In theory, that valuation, barring outside market forces and risk, is probably good for who knows how many years. I mean, if things don't change a lot, I can tell you from an IRS perspective, they don't like that. they have a hard time accepting things more than a year old, for the most part, I would say. And I purely think it's because they are trained to look at the date and say, well, that's a year old, we can't use that. When in reality, they don't understand the underlying principle of it. We've been fine. I tell clients, do valuation at 12/31/19, like Terrell said, gift then, and then do something in January. You know, I mean, yeah, I'd love to do one every single year for you, but you really don't need it unless there's a change between that December and that January, which in most cases it's not. There's really not that significant of a change. So you can transfer shares in December and January and kind of get 2 for 1, the price of 2 for 1. And I tell clients that it's a lot, they like it, and it's a lot easier to do. You know, if like she said, if you stretch it out any longer than that and you're gifting or estate type work, the IRS, once you get beyond 2 years and the values are significant, they probably will question it. Even if you're fine, they still may question that. But I just wanted to add that because I think it's just something that you should know. Generally they're not valuation experts, and they kind of just a lot of times don't know exactly what's going on. So.
Can I butt in just for a quick question? A lot of our the folks that we work with have under 5 employees, right? Or they may not have, you know, shareholders or that sort of thing. Some of them may have done sort of back of the envelope valuations or worked to sort of develop their own. And in that case, you know, if they don't have something as formal as you might be able to provide to a bigger company, do you have some recommendations specifically for that?
As to how to do one, or if you need one?
Well, I suppose both. Like, you know, if we have a lot of tools and resources for folks who are just doing it on their own, but just from a small business standpoint, in terms of having to redo it on their own or thinking about tax concerns, if there's any other things we should keep in consideration for small.
If we have a way to pick them up.
I guess my comment on that would be, if they're doing, you know, a back of the envelope or doing kind of their own calculation, I guess it depends on how they're doing it, but say if they're using their cash flows or they're using their sales or whatever metric they're using for the company to value it, and now they want to kind of update because of COVID.
What do you got, the pickup truck?
They're going to have to.
Pour them right in the pickup truck and leave them right in the pickup?
Somebody's not muted.
It all
Sorry,
depends.
interjected me.
If they're ready to pour now, and we can pour them right now, we'll just leave them in the truck for now. You know what I mean?
Basically, you're going to want to look at those metrics. You're going to have to take into account the kind of business that you're in, the kind of industry that you're in, and how it's going to affect you.
It doesn't have to have
So
a finish on it or anything like that, you know what I mean? It's just
calculation based on your average sales over the last 5 years, but you're thinking your sales are going to be down by 25% for you don't know how long, then maybe that's how you adjust it, just for a quick and dirty calculation.
Mm-hmm.
A lot of how you fix that or update it is going to depend on how you valued it in the first place.
Right.
Okay, thank you.
No problem. So I guess I was kind of done about, as far as valuations, I think we're kind of good there. I don't know if you want to talk about the tax concerns for selling?
Yeah, I guess the only thing I'd add to the shareholder buying, selling agreements is just be cautious when you're doing cross-purchase agreements, shareholder agreements between each other. They don't have to be super, you know, legalese and formal, but obviously there should be some type of agreement. If you have 2 people working together and something happens to one, what happens to their interest in the business? And we've seen over the years a lot of agreements between shareholders that at the time when they're written look good, or the time when they're starting out look good. And we see a lot of, you know, if somebody passes away, we'll be bought out at book value. And that's okay, but now we're dealing with stuff 15 years later, and you have a widow or somebody that's saying, wait a minute, you're offering me like 50 grand for this business when you've done 10 million in sales for, you know, the last 6 years? You're telling me my interest is only worth 50,000? And that's what the agreement says. So they're kind of stuck, but what I have seen is that people don't think they're stuck, and they're not going to settle for that. And it could have been avoided had the agreement had some better wording in it. So we have had our clients, once they get drafted by an attorney, if that, to send them to me, let us look at these and say, is this really where you want to be? You know, 15 years down the road, and say, well, not really. I'm like, well, let's reword it so that maybe we build a formula to use, or depending on the size of the company, we've said, you know, let's put language in the agreement that says the fair market value of the company at the date of death. And it has helped and avoided a lot of consternation between family members, business partners. I just don't think people necessarily think about that at the time they're writing it, and I understand that. It just creates a lot of problems down the road. And the only other thing I'll mention is that because you do a valuation for an operating agreement, for, say, bonus purposes, you're going to value the company and take the earnings and figure a bonus, and that's how you do it. That, in most cases, is likely not a valuation that the IRS would consider fair market value. So if you had to file an estate tax return, even for New York State, or you were going to give shares, they would not accept that as value because it's purely a mechanical formula. So I've
Everybody, Steve Sagan called me up emails me yesterday. It's like, well, we got some penetrations that didn't get fire sealed. You know what I mean?
We still got somebody that's not on mute.
Liquid floor seal.
Danielle, are you able to mute them on your end?
Yeah, I don't see who the person is there. I'm
Water
trying.
seal and fire seal are two different things. Fire seal
I
expands.
think it's the other ANCA person.
You know what I mean? You can't pour, somebody's helping up there. So.
Okay.
That one doesn't have audio.
So, yeah. So we've had clients that have come to us and said, I want to transfer some shares to my son, and we do a valuation internally every year, so here it is. And I have to tell them, sorry, but I can't use that. It's the wrong value.
What do you know? How he does it? Just he
All right,
knows
give
how
me
to-
just a second. I'm going to mute everybody and then just unmute the
That's
presenters.
it, you know what I mean? It's,
Yeah, we're still getting a lot of
What's up?
people talking.
Yeah. But yeah, just keep in mind the type of valuation you need. It's going to depend on what you're using it for. You know, what kind of calculation we can use, or what kind of wording
you
you do, and what kind of.
Are we back on?
Well, hopefully you can hear us.
Can you guys hear us now?
Yeah, we can hear you.
Okay, good. So I guess if we don't have any, we can take questions on that later or whatever. I'll move on to number 4, which was what tax concerns should I be aware of if I sell my business this year? The tax concerns of the tax law radically changed in 2018, and obviously we won't go a tax update now. And we'll get into kind of selling maybe in the next question, but so the law itself hasn't changed. The rates are still the same since 18. How things get taxed haven't changed since 18. Concerns that I see now with selling this year, even at a non-tax standpoint, that I've questioned is the financial strength of the buyer. So we've had people that still, there's still deals going on, believe it or not, and people are looking for deals. And I have clients that if they want to sell, I would question the financial strength of the buyer. Now, a lot of times these are huge companies, so I'm not so concerned about that. But if somebody wants to come in and say buy a small business now, do they have the ability to pay? And are they going to have ability to pay when they take over, and now they have to deal with post-COVID? Is my client buyer going to get paid? You know, if I have losses up to this point because of COVID, and I'm, you know, say I'm a pass-through and I'm a partnership or an S-corp, so those losses or income goes on my personal return, am I able to use those losses to offset any gain that I had maybe when I sell my business? So I think losses and like capital loss carryovers from, say, 2018 or 19, I think are going to become more critical, because you may be able to offset some gains that you, in previous years, maybe would not have generated, and you may end up paying less tax on the sale now than you would have. Whether you get the same price in 2020 for your business, obviously, is a different question. But I think rolling into the next question, as far as structuring the sale, the question was specifically, you know, what's the best way to structure a sale to minimize the seller's liability? I'm going to tell you flat out that it's generally, in most all cases, it's a stock sale, because any gains on a stock sale is at capital rates, so it could be from 0 to 20%, you know, at preferred rates. So in most all cases, if you can sell stock and you can get a buyer that will buy the stock, that's a plus. It's also a plus that any issues or liabilities that you have with the company go with the stock. So as a very good example to the movement of liability from the buyer to the seller, we have a sale going on now that the buyer is a client of ours. He wants to purchase the stock of another company that has somewhere in the neighborhood of $1 million owed to the IRS for back payroll taxes. And he's adamant that he wants to buy stock for certain reasons. And we have made him very aware multiple times that, just remember, when you purchase the stock, that assessment and problems with the IRS comes with the stock. It's yours. You can't get away from it. And he has this idea that he's going to strike a deal with the IRS before the stock sale, which he can't do because he doesn't own the stock. So you can see there's issues with liabilities transfer with a stock that you may not want. There's risk there, and there's other ways to work around that. Now, in some ways, stock deals are necessary, even if they're not advantageous, because, for example, in this case, it's a railroad. So with the railroad, they have certain rights with the government and with other entities as to trackage rights. You know, right-of-ways are big in the rail industry. And trying to get those contracts and right-of-way agreements transferred from one to the other is very difficult. But if you buy the stock, obviously it transfers with the company stock, and it's easy. So that's why they like to do stock sales. But I can also tell you that in most cases, the buyer of the business does not want stock, because when you buy stock, you really get no immediate tax benefit from the purchase of the stock. So if I buy a company for $1 million and I buy the stock, $1 million sits on my balance sheet, I get no deduction for it, and it really doesn't come into much play until I sell it. So what most buyers want is assets, and especially on the small business side, they want assets. So what will happen is they will say, we don't want the stock, and we don't want the risk that comes with your stock, because we don't know what's out there, that somebody may sue you still, or after we're gone. We don't want that. But they do want to buy the assets. So, you know, if you're a trucking company and you have a buyer, they are going to want to buy the hard assets only. They're going to want to buy all the trucks, all the trailers, any other equipment you have, those type of things, because in today's tax world, they can buy those, and in most cases, they can expense those purchases immediately. So we've had some very large asset purchases, you know, $6-7 million of a business, and effectively they have expensed the entire purchase price in year one because of the tax law. So that's very advantageous to a buyer. So the issue with that on the seller side is that when you sell assets, any depreciation you've taken on those assets, you have to pay tax at ordinary rates. So it could be as high as 37%. And you're not going to get that capital gain treatment on those. So as you can imagine, the buyer gets a great tax benefit and the seller gets hammered with a tax rate could be 17% higher than what they had planned on. There are ways to mitigate that. We do it all the time here. There's certain elections that can be made to mitigate that tax effect. And in most cases, the buyer will increase the purchase price enough to cover the extra tax cost of the seller because they get such a great benefit on the asset sale. So I definitely would advise if you're selling and you're selling assets, you're not selling stock, you're selling assets, just be sure that you understand the tax consequences of an asset sale versus a stock sale, because there are some grave differences. And once you're closed, there's not a whole lot that you can do about it.
And we deal with them a lot. I mean, if that's a situation that you're in where you've got an agreement and you're looking to sell and you're curious if you're doing it right or you're going to have the best tax results, I mean, definitely our information will be up at the end, but definitely reach out to us, you know, email us, call us, and, you know, something that we can help you out with, because to find out after the fact and to get a really nasty tax surprise is not usually how people want to find out.
No, it's not good. We've had people say to us not too long ago that, you know, I got my return done from the sale and all of a sudden I owed this, you know, 50 grand. I thought I was going to owe 20. And we're like, yeah, because you sold assets, you know, and now they're kind of, that messes up people's retirement, to be honest with you, that they weren't planning on. And there are definitely ways to mitigate it. It just takes a little bit of time. Like I said, in most cases, the buyer are amenable to maybe paying a little bit more because of the benefit that they can get, or you can at least show them, hey, you're going to get to deduct this and save this. All we're asking for is you're going to save 60 grand. All we're asking is for 10,000 more to cover the tax cost. But that is really, really important, because in most small businesses, people want assets. They don't want stock, like I said, unless it's some odd circumstances that they want certain things that go along with the stock. But mostly all that we see are asset sales. So just be very, very cautious when you're thinking about selling. And it's be clear with your attorney, whoever using it, you know, is this a stock sale or is it an asset sale? Be very, very crystal clear on that.
So I guess I'll kind of quick, oh, go ahead.
Oh, no, I was just going to do a little bit of a time check. That was all.
Okay.
We just have one left on the screen, and then we'll have some time for questions at the end. This one was a little more specific, but kind of interesting. How do I separate the value of the business from the value of our home, as the home is attached to the business and on the same property? That's the first question. Really, that's going to be twofold. To separate the home from the business, really, you're going to need to get a property appraisal done. They would be able to tell you the value of the home piece. And then as far as valuing the business, well, they'd be able to tell you the value of both on a property basis. And then we would do a valuation from there as to the business itself. A lot of times, especially now, that's going to be a cash flow evaluation. And then you would take, I guess it depends on how if you wanted to sell the home along with it, you could show it separately. You could get the value of the business by itself, the home by itself, talk to the buyer as far as what they're looking to buy. But it would definitely be a two-pronged approach. You'd get a business valuation for the business piece, and you'd have a property valuation, so you could split out the home. And then as far as the financing piece, that may be more of a banker question as to how they want it presented. But same thing, we would have the two pieces of valuation, and then you could ideally just add them together. If they wanted to buy both, finance both, you have the business valuation, you have the property value, together is the amount that you're willing to sell for, and then the bank might have some more things that they would want you to list or items that they might want to see prior to financing.
Yeah, we've seen that previous, especially in, not so much anymore, but in older, like gas stations, that people would have the gas station and they would actually live above the gas station. Like I said, not so prevalent today with fast tracks and all these things, but that was pretty common in the North Country, especially. I grew up in the North Country, and there I can think of numerous gas stations where the people lived either out back or above the station. So, and we've dealt with that before. Like I said, it's not so prevalent anymore, but it certainly exists.
So that was all the pre-meeting questions that we had. So if there are any other questions now that anybody wanted us to talk about, we could address those.
We do have two in the chat box that I'll bring up. The first one is from Steve Garnell from the AEDC. So in the context of this conversation, how are you defining value? What are your considerations to establish value?
We would define value, not all the time, but most of the cases, as fair market value as defined by the Internal Revenue Service. So we would define that as a hypothetical willing buyer and willing seller, not each under not duress, so having basically common knowledge. That's how we would define fair market value. We would follow that for IRS purposes because a lot of the work we do is for the IRS. There's different definitions of other value, as is fair value is used in family court a lot, in divorce. That is undefined. In most states, it's undefined. It smells a lot like fair market value, but there certainly are differences between fair value and fair market value. When we go into a court for divorce litigation, we have to use, at least in New York State, we have to use fair value, or if there's a shareholder dissolution, the courts would require that we use fair value. That has different implications. I'm going to tell you, it's pretty close to the same thing. However, the courts make definitions of fair value. For example, they don't allow, in a shareholder dispute, under a fair market statute, we may use a market or a minority interest discount. So if I only own 5% of the company, obviously I don't have any control. There should be discount for that because the value of a 5% versus, say, an 80% is different. When you get to family court and you change the definition, they will not allow that. Or shareholder disputes, they will not allow a minority shareholder to be diluted because he's a minority shareholder. But that is how we define value. We use IRS definition. Like I said, it's a hypothetical willing buyer, willing seller is the definition of it. And I guess what that means is, and I say the word hypothetical is because the IRS is not permitted at this point to look at the person gifting and the person receiving. They are not allowed to look at that. So if the father gifts to the son, in the IRS eyes under that definition, it is a transfer of interest from one person to another person, not father-son. And that makes a big difference because we can still discount those shares, even though, I guess if you looked at it in the real world a lot, it's going from one pocket to the other, father to son. But that is not how it's defined, and that allows us, for those purposes, to take multiple discounts on it. So hopefully that helps, and it's not too technical.
Thank you so much. We have one more, two more questions. So what's an average cost for a business who's going to go get a sort of formal valuation? If somebody wanted to sell and needs to understand how to price their company.
Yeah. Well, it depends on the purpose that we're doing it for. So if we are doing it for estate and gift purposes, we are constrained as to what we do. So we have to follow certain procedures via IRS. So those can range anywhere from $5,000 up, really. For us, we just can't do it for anything less because of the requirements that the IRS puts on us and things that we have to include the work that we have to show that we did, even though honestly, if it's meaningless, it's not meaningless, but they, as you can expect with the government, they want everything plus the kitchen sink when you really don't need the kitchen sink. But unfortunately, we have to sign an independent report, we have to do those things. If you are looking for operating agreements, even divorce, or what we get a lot is like potential sale, or we have an offer and we want to see if it's fair. Depending on the detail that you want us to go down into, I would say, Terrell, what, maybe 2,000 to 4,000,
Yep.
something like that for a formal report. If people call up a lot and say, can you give me an idea, look at my 3 years financials and look at comparables that you can find and give me an idea, it could be 1,000 or less. It depends on what we can find, how fast we could do it. So it really depends on the purpose.
Depends on the end user too, like you
Yeah.
said, if it's going to a government agency, there's very specific rules and guidance that we have to follow, whereas if you're using it internally for your own purposes, it ends up, we can do a little bit less or do just kind of what you're looking for. We can just do those pieces as opposed to doing the full bang valuation
Right.
report.
The problem where we get into, especially with small business, is that they deal with the Small Business Administration. And especially if it's not direct family transfer, the SBA wants independent valuations. So like Terrell said, it was almost like we're doing it for the IRS. But they don't really need a full valuation. So you imagine trying to buy a business for $300,000, and now you got to pay, $8,000 for a business valuation. It's absolutely crazy. And I wouldn't want to pay $8,000 for a business valuation report. I wouldn't do it for that purpose. That's what they want. We've talked to the SBA because we have so many clients that deal with the SBA and said, guys, you're really doing overkill here. We could do this for $2,000 or $2,500 and get the client where they need to be. And as you can imagine, it's extremely difficult, A, to get an answer, and B, to get them to reduce standards. It's really not, but to say we don't need, a Cadillac here for a $300,000 business purpose. We need a $1,500 or $1,000 or $2,000 report that gives the bank some assurance that they can sign off on and say, yeah, we think this is a fair price.
So if you don't mind, I'm just going to take a moment to maybe let Angela, if you don't mind, speak to that a little bit about what that looks like in your office and trying to provide sort of counseling for folks who are looking to do it themselves or smaller businesses for whom a larger valuation might not be the best fit.
Sure.
Thanks. First and foremost, I want to be very clear that the SBDC does not provide valuation services that will necessarily be a legal document. What we do is we do the rule of thumb valuation, look at cash flows, and talk about asset values. We always ask that clients speak to their accountants and their attorneys because we do not provide legal or tax advice. So when we're working with really small business owners to kind of help them start to understand how value is created in a business, what we will look at is the last 3 years of tax returns, and we'll kind of look at net profits. There are some published industry multipliers that we will use to kind of give a range of business value. But business valuation is very subjective, as our speakers have kind of shared today, in terms of it's basically, does the business cash flow for a buyer? So that's where we really do the work with potential sellers is let's look at your numbers from the perspective of a buyer, and that will really help you hopefully come up with a range of value that might be a little more accurate as to what someone was willing to pay. Because if you understand how the buyer is looking at your business, that might kind of settle some of the expectations, because often buyers and sellers they're always at odds, right? We talked about assets versus stock sale right from the get-go. People have different interests. So the same goes in establishing the price, right? On all of our basic valuation tools that we work with small business clients with, I have a disclaimer that says fair market value is the highest price the buyer is willing to pay and the lowest price the seller is willing to accept. So the way that we would look at it is last 2 years of tax returns, what profit, right, is the business generating? Potentially look at some industry multipliers to give you a range, and then work on a cash flow analysis with, you know, if someone needs to get a loan based on the profits your business currently generate, can they still generate a profit, and start the conversation there. We'll look at potentially what's included in the business sale and things of that nature. But definitely to understand the tax implications, we always refer people to talk to their accountants, because that is not something we get involved with. So hopefully that helps, answers that question, Danny.
Yeah, thank you so much for sharing that. We really appreciate your insight there. Is there, before we sort of start wrapping up here, because we are kind of at time, I do want to also give the opportunity for the ADC, any of our representatives of the ADC, to maybe share anything that they do, or that they would like, or that they might be able to help with for small businesses in the region as well. Oh, it looks like Victoria had to leave us. Stephanie, would you be able to speak to that?
Stephanie's still on the call. Yeah, okay.
Okay. Well, we are
Sorry,
getting.
I had to unmute. I'm sorry.
That's okay.
Here. Actually, this will probably be more of a Steve question. Is Steve on the call still? Can you tell if Steve Gardner is?
He is, but he looks like he's on the phone.
Oh, okay. Yeah, what we usually do is we look at the individual client situation, and as far as valuation of businesses, we usually refer them somewhere. So we would refer them to the SBDC, or also we have them discuss it with their attorney and their accountants.
All right. Well, thank you so much for that insight, everyone. I want to just take a moment and thank our friends again from Bowers & Company to be able to sort of join us and answer some of these questions, and really chat with us about what things might be affecting their valuation and what to expect this year. I know we're getting on towards, you know, the wrapping up here. Is there anybody that has a burning question that they just need to throw out there and see if we can get answered in the next, you know, minute or so?
Hey, Danielle, if you wanted to take a second, I don't know if you wanted to put our information up on the screen. That way, if anybody did have any questions or wanted to contact us after the fact, they'd have our contact info.
Absolutely, and I'll also share it out to everyone after the program too that was here and registered.
Perfect, thank you.
Or Kim. Anybody? Last burning question? And what I'm going to do is I'm just going to put the information in the chat box real quick with their phone and information. And you'll be able to, and I'll send all of that out in an email to everyone who was registered. So thank you so much, folks. Thank you so much, Terrell. Thank you, Rick. Thank you for all of our partners and individuals on the phone. And thanks for tuning in. And we hope that some of this information could have been helpful for you. And please, you know, follow up with folks if any of these services are something you need sort of professional assistance with. And we look forward to continuing this series over the summer with additional programs and guest speakers. Thank you, everybody. Have a great day.
Thanks, Danny.
Thank you. Thanks, Danny.